When Jim Cramer called XRP a con on live television at 38 cents, retail investors panicked and hit the sell button. But Elon Musk was right when he said, "The inverse Cramer indicator is rarely wrong." While the media was busy trying to figure out how to make the crowd lose their money, the world's most powerful bank was quietly crowning a new king. The era of operating in the shadows has officially ended. The institutions that mocked XRP for years are now welding it into their core architecture. Are you listening to the fairy tales about the death of altcoins, or are you watching the $13 trillion of institutional liquidity preparing to flood through Ripple's rails? Today we decode the cold math and the documents that prove XRP is not just a token, it is your ticket out of the rat race. We are just days away from a historic date, the March 1st, 2026 deadline for the Clarity Act. According to White House crypto advisor Patrick Witt, this isn't just another bill to be kicked down the road. It is the mass adoption switch that will change the digital asset landscape forever. The U.S. has realized it can no longer afford to slow down the inevitable. At the same time, a stunning reversal is taking place. JPMorgan Chase, the absolute hegemon of traditional banking, has essentially recognized XRP as the premier digital asset for the banking sector in an internal strategic report for its international partners. We are talking about unprecedented institutional utility and scalability. The choice is simple. You either embrace this technology or you get left behind in the dust with outdated legacy banking. We are no longer waiting for pilot programs. As of January 2026, next-generation instant cross-border payments have officially launched on the SWIFT network. More than 30 banks in 17 countries are already using this system. This is the year of fast-tracked utility, where ISO 2022 compliant assets like XRP, XLM, and XDC are being integrated into the global rails. Their mission is to make money move as fast as sending an email. Why won't Wall Street choose Bitcoin for settlements? The answer lies in brutal regulatory arbitrage. The SEC has implemented new capital rules for broker-dealers. Stablecoins now receive a haircut of just 2%. This means financial institutions can treat 98% of their stablecoins on their balance sheets exactly like fiat dollars. Meanwhile, Bitcoin and Ethereum have been hit with a punishing 20% haircut. Think about the balance sheet math. If a bank holds $100 million in BTC as collateral, the regulator only recognizes $80 million. No major player is going to freeze their capital in a speculative asset that instantly burns 20% of its collateral value and has no built-in utility for settlements. Capital always flows where it is most efficient. That is exactly why liquidity is shifting to stablecoins and XRP. While other crypto projects were busy selling pictures of monkeys, Ripple spent the last few years buying up infrastructure. They are building a monopoly in the clearing market. A $250 million deal with Medico for bank-grade custodial storage, standard custody to secure critical licenses for trust operations, and Palisade for wallet-as-a-service infrastructure. Ripple is no longer just a blockchain company. They have created an architecture of prime brokerage, clearing, and financing for XRP and their RLUSD stablecoin. They have built the complete bank of the future. By July 2026, a new regulatory wall will rise. California is introducing mandatory licensing for crypto companies, mirroring the strict implementation of MiCA in Europe. Most crypto startups will go bankrupt overnight because they simply cannot meet these standards. Ripple, on the other hand, possesses a regulatory shield. Being officially recognized as a non-security, XRP will become the primary collateral for the on-demand liquidity system in a world where every transaction is tracked. Regulators are not killing crypto, They are clearing the path for the winners by destroying zombie assets with no real-world application. Fundamentals are the fuel, but the chart is the roadmap. If we open the monthly time frame on TradingView and switch to a logarithmic scale, we see what most retail traders are missing. XRP is completing a historic 7-year symmetrical triangle. This isn't just a technical analysis pattern. It is the electrocardiogram of the most massive institutional accumulation phase in crypto history. The spring has been compressing since 2018. Let's turn off our emotions and look at the cold Fibonacci levels. Phase 1. Breakout and retail FOMO. As soon as the price breaks the all-time high around $3.84, we enter price discovery. The first algorithmic target is the macro 1.618 Fibonacci extension, which points exactly to the $10 to $13 range. This is where the crowd will start panic buying, thinking they barely caught the train. But this is just the warm-up. Phase 2. Institutional vacuum. The $100 mark is not a fantasy. If you draw a Fibonacci retracement from the 2018 peak to the macro bottom, the 4.236 level lands perfectly in this range. When the new regulatory rules kick in, that 2% stablecoin discount versus the 20% BTC penalty, Wall Street liquidity will pour into utility networks. XRP enters a liquidity vacuum, an area with zero historical resistance levels. Phase 3. The 2017 fractal correlation. Why are the $500 and $1,000 targets mathematically justified? We need to look at the correlation with the 2017 fractal. Back then, XRP rallied over 60,000% in a single cycle, and that happened entirely on retail money. Today, we are talking about swift integration and $13 trillion of institutional capital. If we apply that same impulsive fractal to the current macro structure, the 14.618 and 27.618 algorithmic Fibonacci extensions take us straight into the hundreds and thousands of dollars per coin. Furthermore, pay attention to the Bitcoin Dominance Index. Once it breaks its global support and begins a rapid decline, we will witness the greatest capital rotation in history. Smart money will shift funds from digital gold with a 20% penalty discount into the digital oil of the new banking system, XRP. Charts don't lie. They have already priced in what the news will only write about next year. Most people don't understand what wealth is. Wealth is not having millions in your account. It is the sovereignty of time. It is the ability to escape the 9-to-5 system. Let's do the math. Institutions are entering this market to make money. They will push crypto integration into retail, supermarkets, and global commerce. And when that happens, the price targets will break the psychology of the masses. $100 per XRP. This is the first supply shock, an amount that will change many lives, but won't provide absolute freedom just yet. $500 per XRP. The zone where retail will start cashing out aggressively. But the data shows that by 2029, this price will look like an absolute steal. $1,000 to $2,000 per XRP, the global unit of account level. This is exactly where a properly sized initial position turns into $1 to $2 million or more. This is the ultimate retirement target. The Lambo trap. 99% of people will instantly lose this money once they get it. They will buy a mansion and a supercar, only to find themselves drowning in property taxes and maintenance costs. The smart money approach is different. You hold the asset and fund your lifestyle entirely through passive income generated by secure staking. Why will 99.9% lose everything? Because they panic sell on red days. They view crypto as a get-rich-quick scheme rather than a fundamental technological shift. If you have read the white paper, if you have been tracking the expansion of Ripple's institutional clearing, you know that holding XRP is simply a test of patience. We aren't going to spend our XRP on a cup of coffee. We are waiting until it becomes the global standard for settlements. Are you getting distracted by influencer noise? Or are you watching the institutional on-ramps being built for your wealth? Stay calm, think in numbers, and do not give in to panic.